Hey guys, Mr. Tweet here. So in this video today, I'm going to be going over kind of similarities, differences between our spending multiplier and our money multiplier. Now, in both instances, we have this, this part of our equation that we're using here called the multiplier. The spending multiplier is 1 over the rate at which people save money, and my money multiplier is 1 over the rate at which banks save money, which we call the reserve ratio. So if we change this reserve ratio, it changes this multiplier, just like changing MPS changed our multiplier back when we were going over fiscal policy. So now in monetary policy, notice that like what we're finding here is not a total change in GDP. So it's not directly the same. This doesn't like automatically close a gap, for instance, or this doesn't tell you how much aggregate demand is shifting, right, on a graph. What this right here is doing is it's telling us that when there's some amount of M1 added to or taken out of the economy, the effect of that M1 that's pulled out or put into the economy is going to be larger than just the amount itself, that there's going to be a ripple effect like there was with fiscal policy, how there's a spending ripple. Here, there's a money ripple. So what's happening here, again, this part of the equation, our change in M1, this is going to be money that's put in or money that's taken out of the economy. So typically, like this is what the Fed is doing right here, is that the Fed is moving money in or moving money out of the economy. We just need to be aware that if the Fed moves $5 million, it's going to have a bigger effect than that. Just like how if the government spends $5 million, it has a bigger effect on GDP. When the Fed moves in or out $5 million, it's going to have a bigger effect on the total money supply, right? So this money supply right here, this is the supply curve on the money market graph. So that when we look at that supply curve on the money market graph, right, what causes it to increase or decrease? Well, the Fed, they can put money in, they can take money out, but they can also change this, that if they make the reserve ratio smaller, the multiplier gets bigger, the supply of money gets bigger. Or if they make the reserve ratio bigger, the multiplier gets smaller, so then the supply of money gets smaller. So really what you're seeing here is a couple of different things. The first one is that the Fed can change the reserve ratio to change the money supply. But this is a really big move. It doesn't happen very often. During the pandemic in March, they did lower the reserve ratio because it was like instantaneous economic disaster. So, takes a sledgehammer to solve a really big problem. Changing your reserve ratio is a sledgehammer. You don't use it very often, except for when you have, a really big change you want to make in something, right? What we're going to learn about in the next section are other ways that the Fed could change the amount of money in the economy, which then would lead to a change, not quite as significant as change in the reserve ratio, but they could put money in or take money out, and then that leads to a change in our money supply. So that's our, this is our equation using our spending multiplier, and then here we are using our money multiplier to figure out kind of how changes in the reserve ratio would lead to changes in our money supply. So anyways, I'll see you guys in the next video. Peace.